Hello, everyone. Welcome. We're here to share our investment secrets with you. First of all, I want to thank BIC again for having us here. And the idea actually came from him. He said that it would be nice to have a master class about investing. And then since our specialty is blockchain and crypto assets, we customized that idea and changed it into how to invest in blockchain-powered projects. So a quick intro about us. We are Blockchain Investors Consortium founders, and we have an advisory firm called Beyond Enterprises, which focuses on blockchain-related projects. We advise companies, governments, funds on how to incorporate best practices in blockchain. And now today we're gonna talk to you about best practices in investing in blockchain. Quick note, Blockchain Investors Consortium is a consortium of funds that has around $6 billion under crypto assets under management. So we looked at a lot of deals and deployed some capital in the space. And Beyond, as I said, is a strategic advisory firm that helps different entities get into the space. Joanna, you want to introduce yourself?
Hi everyone, my name is Ioana Frâncu. I am the Chief Operations Officer of Beyond Enterprises, and I spent the past years working in technology, from corporations where I did machine learning to blockchain now. I have the first company in Romania that ever did commercial blockchain projects, and among the first ones in Europe. When I started, we were 1% women in the blockchain area. And I'm also part of Forbes 30 Under 30 batch of 2017. What I do is to assist companies into including blockchain in their technical projects and to help them leverage the innovation side of their business, whether I'm working with a corporation or a startup. So I'm also here to discuss about your projects and any kind of challenges that you are facing after the masterclass. Thank you.
Hi, my name is Jason Fishman. I'm a marketer. Over the past 10 years, I've worked on all sides of the marketing trade, from agency, client direct, and vendor servicing agencies. As an investor in blockchain projects, as an investor in client projects, I'm here to provide my marketing perspective on what I look for in a marketing model, in a growth model for private round investments and beyond. Have the privilege of working with Brad and Ioana on Beyond Enterprise projects, and we'll be able to bring all types of knowledge to the table. Over the past 5 years, I've worked on over 250 projects, over 100 of which with fundraising initiatives. I've dove deep into marketing models, and we'll be able to point out the key factors to a successful marketing strategy within an investment opportunity.
Finally, my name is Brad Yasar, and I've been investing in private deals for over a decade. It started long before blockchain, then narrowed my focus to blockchain. All this information is just to let you know that the people you have on stage have dealt with a lot of due diligence in this space and worked on a lot of projects. So we're sharing hands-on experience and personal learnings with you, not some theoretical information that we read somewhere. So, what do we look for when investing in blockchain projects? The most important thing, and if you listen to any of the speeches this morning or earlier this afternoon, this idea has been echoed several times, is the importance of the team. What we do is we invest in founders, not ideas, not technologies. And there's a reason for that, because everything in a project can be changed. With an experienced investor, with an experienced board, experienced C-level executives, you can modify everything about a project. But the founding team members and their attitudes are very hard to change, and it takes a long time. So a team that's poorly chosen for the project can make even the best idea fail. So why do we focus on the team? Because we want to make sure that the team has the experience, the right attitude, and the track record to reduce the execution risk. When you look at an investment, you have a couple buckets of risk that you need to manage. There's technology risk, there's funding risk, and there's execution risk. And again, you can fix the funding risk by bringing more funding into the project, change the technology, but the team is the most difficult to change. It all starts with a good attitude. So if the team is resilient and passionate, the project has higher chances of being successful. So that's number one thing to look at. Long before you read the pitch deck, white paper, you should get a first-hand feel about how the team is tackling and what their mindset is. The second is the track record. I highly recommend, and I know every investor in this room already does this, but it's so important we want to reiterate it. Do your due diligence. Verify the claims the team is making. Just looking at a document that's presented to you and taking their word for it usually does not lead to good results. If you fact check things, you may see that there are areas that were missed or that can be improved. Second most important thing is commitment to the project. I like seeing teams that are committed. If someone is starting a business as a hobby, for me, that's not a good investment. So everyone who has a high-level job, has nothing on the line, and do something on the side and asking you for money, you should shy away from. There are exceptions, but as a rule of thumb, those people are not going to be 100% in their side project because it's just a hobby. The next important thing is the balance of the team. So when you have a founding team, you want to have a balanced team. What I mean by that is you want to have a technical co-founder, you want to have an operational co-founder, and if possible, you want to have a sales, marketing co-founder. Because if you have these three areas covered, your overhead initially is going to be very low. If you have to bring outside help to build the technology, that's going to be expensive. If you need outside help to go sell because none of the founders are able to go and sell the product, your overhead is going to be really high because those are really high demand, high ticket people to bring into a new project. And our goal as investors in the project is to get to the product, get to sales with the smallest possible budget so that we both protect the founder's stake in the project as well as ours. Good examples of teams to invest in. Serial entrepreneurs with past exits who are co-investing with you. That's the best case scenario. If you have a serial entrepreneur, you see the track record, you see the results, and if they believe in this new project as much as you do, they become your co-investors. So it's no longer, I'm putting my time, I'm putting my blood, sweat, and tears, and you're just putting money, but it's you're putting money, I'm putting money. On top of it, I'm going to do everything to make this a success. That's the best case scenario. A couple examples to avoid. These are examples of founders. Coachable founders. If someone is unable to take criticism and turn it into positive action, for me, that's a non-starter. Because those entrepreneurs, those founders are going to have challenges. They're not going to listen, and the results are not going to be ideal. Inexperienced and impatient teams, that goes hand in hand. Sometimes inexperience can be okay if they're highly coachable and the idea is amazing, but most of the time, you want someone to learn at least business basics or the technology or the industry basics by working somewhere, and not just graduate and have an idea and get a bunch of money and try to execute on it. Because then you face impatient teams, and the lack of experience makes the process so long that they give up. Lack of market understanding, another crucial thing. You may have a great idea, but if you don't understand the market you're going into, you're going to have issues, because there's going to be market-related challenges that you didn't thought of when you're designing the product or the service or whatever you're doing. And lastly, lack of technical know-how. I cannot emphasize how many times I looked at a pitch or a business plan and the numbers made no sense. Just for some color, I have a technical background, so I can kind of gauge where the budget needs to be for a specific technology build. And every time I see this, I stop on the investment side and say, you need to do more research, because what you're proposing is not realistic. You're not going to build anything with that kind of budget. Or your budget is so much larger than what you need, you probably don't know how to have an agile, properly budgeted development. Second part is, of course, the business model. So if the team checks up, it's a good team, solid team, they're coachable, they have the right attitude, then we look at the business model. Is the business innovative enough? Is the product disruptive enough to warrant an investment? There are a lot of technologies, a lot of business ideas that may be good. They may create amazing lifestyle businesses for entrepreneurs. And by lifestyle business, I mean the business supports their lifestyle. But they're not good investments for us, because we expect a return on our investment. We don't want the business to just sustain the founders with our investment. We want to see a return, and we want to be able to get it out of there. So I usually shy away from marginal improvements to an existing product. I mean, we've been pitched probably a dozen Facebooks, Twitters on the blockchain. Yes, it solves some of the issues of ownership of data or things like that, but it's not big enough leap to create a great return on your investment. I mean, best thing you can expect from investing in Facebook on blockchain is Facebook acquiring the business for a small multiple. So that's not that good of a investment. Additionally, this is very important for blockchain businesses. When you insert blockchain technology into any business, the cost goes up. So suddenly, if your tech budget was 100K, it becomes 300, because you're building brand new technology from scratch, never before built. So the blockchain, the idea has to be innovative enough to warrant the additional cost, and the blockchain has to be integral to what they're building. My number one question to ask, and this is a deal breaker, is can you do this without blockchain? If the answer is yes, it's not a good investment, because then you can go the traditional route, you can use a centralized model, you can do everything that we have been doing prior to this new blockchain revolution starting a couple of years ago, and still have a good business. So I'm not saying it's not an investable business, but if they are asking you to invest in tokens or invest in a blockchain company, that's not a good idea. Next is market size. Again, we're investors. Obviously, we support entrepreneurs. Obviously, we do it to bring good ideas to life. But at the end of the day, how long can you invest if there's no return on your investment? I mean, there has to be some life cycle of your investment coming back to you, ideally with multiples, so you can keep doing it. So market size, if it's not large enough, it's a pass for me. A great idea, again, does not necessarily equal great returns, because you may have a highly innovative, amazing idea that only affects lives of 5,000 people in the world. Again, that could be a really good lifestyle business. It's not an investor business, because 5,000 people is never going to take the business to a level where my angel investment is going to have a good return. barriers of entry. Why are they important? Because NDAs don't work. I don't know if anyone in this room has signed NDAs. Have you signed an NDA before? I'm sure we all have. Have you ever enforced an NDA on someone? Have you ever sued someone because they stole your idea and built it faster than you and went to market? No, it doesn't work. So what are the barriers of entry to the market? These are all questions you should ask and see if the entrepreneurs can either answer it or have it already answered in their documents. And how is the team overcoming them? Because barriers of entry are good, but as a newcomer, you have to surpass them first before they can protect you in your industry. So how are they breaking through those barriers? And then once they have market share, how are they protecting it? IPs are good, mostly team. If the team has some unfair strategic advantage, that's a great thing, because you can't replicate human beings as easy as ideas. So if the idea is very unique and the only people that can execute it well are the founding team, you have a winner. Equally important are strategic partnerships. So this changes from project to project, but it helps a lot before I make an investment to look at who has access to strategic partners. Have they even thought about having strategic partnerships? I come across a lot of projects where they talk about user acquisition, and they'll throw some random number. Oh, I'm going to acquire users for 20 cents. And Jason is going to talk about it, but most of the time that's not true. You can't acquire your users for 20 cents. It's going to be $80, $100. So if they have a strategic partnership expansion model, they've already won that battle, because now they're not looking into single acquisition of their users, they're looking at batches, groups of people coming in. So this is a really good advantage. And then of course, once they describe what the strategic partner looks like, who's going to bring those partners on board? Is it going to be them? Do they have the relationships? Is it going to be the advisors, their board? Or is it going to be you? So if you're a strategic investor and they are looking up to you to bring the strategic partnerships, again, that changes the conversation. It's not a deal breaker, but you may want to put some conditions on your investment so that not everyone is sitting in their offices waiting for you to bring the strategic partners. Key clients, very similar. Have they defined who's going to be their key clients? Again, Joanna is going to mention a few more points about this, but not everyone is your client. So whenever I see a pitch deck where it says total addressable market 8 billion people, that's a red flag. That means they have no idea where to start. They're just saying, oh, this is so ubiquitous that everyone's going to use it. And that's not true in most cases. And one step further, not only who's going to use the product, but has this product been pre-sold? So the first company I created, and this was by pure luck, I created it after going and talking to a bunch of people about the software I wanted to write. I said, hey, would you like something like this? Would you use it? Because in my mind, I wanted to have 5, 10 people that says, Brad, we love this. Yeah, we'll definitely use it, before I start allocating hundreds of hours to building something. 50% of the projects I see don't do this. Forget all about selling the product, having revenue, having a business, and they start building stuff. They raise money, they build stuff, they raise more money because they don't have a model to sell it. That's a big red flag again. Then the most important thing is, what are the prospective acquisition targets? There was a period, maybe 3 years ago, where every pitch deck I saw had a slide about who the acquirers, potential acquirers, exits would be. It was a forecast, but it was still nice to see that someone thought about it. Lately, it's gone. No one talks about an acquisition, especially in the blockchain space. They're like, oh, when the token gets listed somewhere, you'll have liquidity. That's not a good enough strategy. We want to see an exit strategy, both on the crypto asset side as well as the equity side. And even if that strategy is not applicable to what I'm investing into, so I may get tokens and they may have an equity exit strategy, it's still a good sign that they think about these things. And who's going to acquire the company and why? Most of the time, your users, your best channel partners, if they're larger than you and if they have the liquidity, those are going to be the ones that are going to be your easiest targets. And then finally, simple business metrics. But these are important because do they have margins and revenue somehow defined, forecasted? Are they realistic? Again, you know, I'm going to be $1 billion company in 3 years unless there's a step-by-step roadmap on why that's going to happen is not a good reason to invest in that company. What are they considering when forecasting? So have they thought about market conditions, market sentiment? Do they have actual data? Have they done any homework? Very important to see these things. Even if they're not 100% accurate, and even if you disagree with them, having these in a business plan and a pitch deck is much more positive than not having them. Because otherwise, do they really understand what it takes to sustain and grow a business? We don't know. Maybe they don't. Maybe they're all technologists, they want to build stuff. Terms, we all look at terms. In the crypto space and for blockchain companies, there is an added twist to the terms. So what are the terms of investment? Are they fair? I like fair deals. I changed term sheets to my detriment several times because I knew if I got 60% of a company for a seed investment, the next round, there's no one, no one's going to be interested in that because founders own less than the original investor. That's not a good balanced cap table. So what you want to do is take your experiences from exits you might have had or projects you invested in that yielded really good results and help the entrepreneurs understand this is the structure that's going to carry you to a successful exit. And finally, for blockchain, you all heard of tokens. Tokens are digital units of something. They represent something. So if they're selling you tokens, where's the value being captured? Because it's really important to understand the challenge for a blockchain company, the founder's challenge is where do you capture the value? The value created by your business activities, do they go only into your digital assets, your tokens and coins, or do they go to your equity? And if you can't figure out where they're capturing it, then the easiest way is to have a hybrid approach and ask for both tokens and equity. So that way, regardless of where the value creation is captured, you benefit from it. Now, Joanna is going to talk about a little bit of product design and technical stuff, and then we'll have Jason.
Okay, for those of you that arrived later, as I said earlier, I'm mostly involved in products and tech. How many of you here have a business idea? Just raise your hands. Doesn't matter the idea. Just a regular business that you would love to have. 1, 2, okay, 3. One of the best investors in the world, actually the first investor of Google, and I'm gonna let you Google him, says something really, really on point. Ideas are worthless. Execution is priceless. Everyone signs NDAs. Actually, a good friend of mine whose project I know very well asked me to sign the NDA in order to give him a software code. And I was like, it's good that you asked me to sign an NDA, but if I would really, really want, I would ask my other company to implement your idea and I wouldn't break the NDA. There are so many ways in which you can break these kind of documents, but the only difference between you and the founders is that they're passionate about the idea. Of course, as investors, we don't do charity work, right? Or at least we don't do charity work by investing in companies. I do that for the Red Cross or Save the Children. But what we do is to put money in a company, the company multiplies it, our revenues multiply, then we sell, and we get more money for that, right? 1 time more, 2 times, 10 times. So it's really important how the team structures their product. If their product is plain, already implemented, all Uber drivers want to make a new Uber, by the way. They have pitched that to me in so many ways that now I avoid even saying the word software when I go into a car. And everyone that is frustrated with Facebook tries to do a new Facebook. And that doesn't really help. I mean, if I already have an iPhone, why would I make another iPhone identical to this one? If I already have this nice skirt, why would I sell one identical to it? H&M already does them, and it's so cheap that it's really difficult to beat them. All these large companies have optimized everything that much that creating something identical is just your waste of time, actually your waste of money, and the founder's waste of time. So I'm going to speak a bit about how technology influences the products and why it is important, and how to not be tricked into believing that the technology is better than other, because they're all good, but they're good at different things. So, from idea to reality, how do companies validate their product? Whenever someone comes to me and they say, I have a business idea, I've wrote a product design document, everything is ready, I just needed to look at the pitch deck and it will be done and I can get an investment, like $1 million seed investment. And I'm like, okay, let's see, how many people have answered the question, would you like to use this product? And even the question, would you like to use this product, is wrong, because everyone would like to use your product until they have to pay. So it's good to ask questions about how they have consulted the market. Did they do an online form? Did they go to on the street with something to ask people about their idea? And did they in any way interacted with the world about it? We have this problem with Romanian co-founders, for example. They never talk to anybody about their idea because they're afraid that someone will steal it. You know, put them in their idea bag, implement it faster. As I said, execution is key, not the idea. So, after people validate or not their products, they come to you and they say, I'd like this investment. And I'm like, okay, who's your client? What is the person that buys your product? Is it a millennial like me? Do they like everything digital? Or is it my grandma who likes everything made of wood and really old furniture and really old objects? Is it an online product or an offline product? And sometimes people say, well, our product can be used by anyone. Okay, if it can be used by anyone, it will be used by no one. When a market is that big that everyone on the market is your client, market penetration becomes impossible. You cannot go and sell the product to everyone. It's just like clothing. My mother will not wear the same clothes as me. Brad will definitely not wear the same clothes as me. And we will definitely not like the same phone. This is why we have different types of items on the market. So when a founder comes and says that they believe that everyone is their client, that's a bad sign. It's important to either come with a very, very clear view of what market segment buys their idea, how scalable that market segment is, and also how they're going to interact with it. For example, right now, there's a whole development trend in Africa where the median age is 18 compared to the rest of the world where the median age is 35. And more companies want to invest in education there, because in the future, over 90% of the world's children will be born there. So it makes great sense to create a university in Africa, in a country there, right? Because you'll be able to educate as many people as possible and you'll create a very highly skilled workforce. It's the same in technology. If my product is designed for 17-year-olds like Snapchat, 13-year-olds will use it, then 21-year-olds will use it, and those people will grow and will continue to use it because they already been acquired by users, and the new users that will come through will be 14. So they will keep using the product for at least 5 or 6 years. That's a good sign of the way you can scale a product. Also, all ideas are packed shiny. They have all the nice features. Like, what if I had an app that allows me to get to places, also order my food, and also call someone to clean my house, and also allow me to see the cultural heritage sites in my country, so on and so forth. But if the app is made to help you get from one point to another, does it really have to help you find cultural places? No. It's not meant to help you like this. So what I do with all founders is to go through the MOSSCO approach. The MOSSCO approach is a way in which you can split product features in a discussion with a startup founder based on the need that they have. It has been proven to be the best in the world. It's been used for at least 30 years. And so far I haven't found anything that's better. Basically, we take the features of a product and we split them in 4 columns. Must have, should have, could have, and won't have. Usually the won't have column is also dubbed as might have, but it's named wrongly. It should always be won't have. So the must-have features are requirements that are critical to the current delivery time box in order for the product to be a success. So if I'm making a maps application, I will need GPS. That's a must-have feature. Without knowing where I am, I cannot know where I'm going. And no one wears a compass in their pocket to realize where they are. Also, the should-have requirements, which are like the next in priority, are requirements that are important but not necessary for the delivery in the current delivery time box. It would be nice for that application to show me all the names of the street around me at a high-level view, or to send me notifications. But right now, in order to deliver it, I just need the GPS. So I'm just going to use that feature. The should-have features are usually implemented right after the must-have features are done, and the product is already launched as an MVP for beta testing and for fine-tuning. The could-have features are requirements desirable but not necessary. These are usually interface customizations, any cosmetic, nice improvement that a user might like. They are not critical to the way that the product works. The user will still not have impediments in using the product, but they are just making it prettier. For example, this is a feature that Instagram has now, that you have an Instagram sticker that you can scan, and I think you saw it at some booths here. But it has never been critical to Instagram, so they launched it, I think, 4 years after Instagram was created. Also, the LinkedIn QR feature, you know, the code that you can scan to get someone's contact with your phone. It was created almost 10 years after LinkedIn entered on the market. It was not a must-have product. I can also type your name. I can give you my phone and you type your own name. So I don't really need that feature. It was good to wait until they had hundreds of millions of users. And there's also the won't have feature. I don't need to see the history of each place on the map. I can Google that. This won't have column, basically, comprises of requirements that have been agreed by stakeholders as the least critical, lowest payback items, or not appropriate at that time. And trust me, if one of the product feature has fallen into that box, it won't be appropriate at any time. LinkedIn doesn't allow you to share pictures that only last for 12 hours. Why would you need that there, right? It's basically a won't have feature. It will never do that. So whenever you have founders that pitch ideas to you, it's better to see if they went through this kind of thinking process. I usually do that with all the companies that come to me before they go to investors, to make them aware of where they are on the market. And usually you can split these features like this after you do a bit of market research. So they should start with doing a research on who would use their product, then what they would use and what not from their product, and then everything should fall naturally into these 4 boxes. Okay. After you finish with designing the product, deciding what features you need, what platform you use. By the way, if someone is doing a web-based social network today, it will be dead. No one uses the laptops anymore for that. After they choose everything, they have to build it somehow. As I said, ideas are nice to have, but execution is the must-have here. So, when people start building things, they create a tech stack that they start with. The tech stack is a very simple way of saying what technologies we are using to put a product together. And guys, can you help me with zooming in a bit on the tech stack slide? Make it a bit bigger so everyone can understand what's there. And scroll a bit. So, the technology stack is a combination of programming languages that allow users to develop a mobile app, and the developer uses this combination of technologies to use it. Like you hear Ethereum, for example, for blockchain is a technology. When you hear, perfect, thank you. When you hear Node.js, that's a framework. When you hear JavaScript, that's a programming language. So usually a product is formed of, does this work? Yes. A product is formed from a server-side component and a client-side component. And between them is the internet. The Facebook app that you see on your phone, for example, is a client-side application. Basically, it runs on your phone and it uses the internet to communicate with a server where you can see all these components. The web server, databases, web frameworks, all this stuff. So all the cosmetic nice things that the users like are here, and all the complicated infrastructure behind it is here. Usually blockchain falls into this part. Personally, I don't consider any project a blockchain project, because my mother won't have her 24 words passkey to open it. Every project is a combination of languages. Usually when we talk about a project that involves blockchain, we think of blockchain used together with a web technology and then a mobile technology. These used together create an interface for the user and allow the user to interact with the underlying technology. Best case scenario, the user doesn't even notices that they're using the blockchain. The user simply takes advantage of the features, and you as investors and the entrepreneurs know what's behind this. If someone feels the need to say blockchain in their marketing materials to the end user, in my opinion, they might have done something wrong. They should talk about how easy the product is to use. And I'm gonna go back to Facebook here. You don't know that Facebook is written in PHP and JavaScript. You know that Facebook is a social network that helps you connect with people around you. So they never needed the technology argument to promote their product, and it should never be one. And that takes us to choosing the right technology. People like to throw in tech words and buzzwords all the time in their pitches, especially when they're saying, we've been building that using name random technology. Right now, I have split the most popular ones into 3 categories. For quick MVPs, but as well as ongoing projects, you can use Node.js, which basically is the JavaScript framework for the server side. Remember the complicated infrastructure behind the product. Then, for really quick MVPs to show a quick demo to an investor, people might use also Ruby. But when it comes to parsing data and managing large chunks of it, Python is a very popular language, and it's used mostly in scientific and academic environments. And then we also have Java and C#, which are also good for long-term projects, but are more general technologies. Java was popular on the Android platform for developing Android apps, but now is being replaced by another language. So right now, I'm really happy when I see founders using Node.js and C#. I think these are the most scalable languages. When I hear PHP, I run. because it's such an old decrepit technology that doesn't synchronize with others, and I don't find it viable for the large-scale projects that people want to build. So when it comes to scaling up, and especially using blockchain, PHP is not the best choice. I usually go with Node.js for blockchain because it can gather the events from a blockchain faster. So from a technical perspective, it's 10 times faster than PHP. Again, can the tech stack kill my project? No, it cannot. But choosing the wrong tech stack can also cause a lot of overhead on a project. If you choose a very unknown language, such as Rust, has anyone heard of Rust here? No, exactly. No one even heard of it. It's such a rare language, and people that are building on it are very expensive. The less people are in a technology, the more expensive it gets to use it. I'm a very good assembler and Lisp writer. If I would go to development now, I would earn probably 5K per month just because there's no another person using it. So you should see that the founders have chosen languages and technologies that are popular. That means that there's a community around them, that people like to use them, and that there's a contribution to it. Also, they're way cheaper. So the costs of development will decrease considerably. So the wrong technology will never kill a project, but it will definitely change the time to market, the expenses, and you don't want to just spend, I don't know, $1 million on technology and be left with only $10,000 for the marketing. It should be balanced, and that's the best way to go when it comes to technology. Has anyone got any questions so far? No questions, perfect. Brad?
Okay, I want to clarify one thing. Obviously, you may not be as technical as Joanna, so the message, if I had to summarize, is just have a technical due diligence done on the project. And I mean, these are a couple of keywords we shared with you so you can look at it and say, oh, I remember that from that class. But aside from that, we are not saying do technical due diligence by yourself by any measure. Have an expert do it and give you an honest opinion. I'm going to go really quick over this part because quick caveat, I'm not an attorney. This does not constitute legal advice. This is just a couple of things. It's very important to look at the legal and regulatory structure of the project before you invest, especially in blockchain. I mean, this applies to any investment, but we want to make sure that you understand there are friendly jurisdictions. Some you may know of, some probably lesser known. Netherlands, Switzerland, Gibraltar, Slovenia, Malta, Estonia, Ukraine in Europe, and then some Asian countries, Australia. These are very friendly to blockchain projects. And then you have less friendly jurisdictions like United States, China, where even a simple mistake in the formation of the company can get everyone involved with the company in trouble, including the investors. So always consult an attorney, and preferably an attorney that knows the regulations and laws of the country that the project was incorporated in. Side note, we're going to have all the slides with notes available to everyone who attends the class and gives us their email, so you don't have to try to take pictures or anything. You'll get the PDF version. Legal structure, simple question, is this the right structure for the project? If you ask that question and you can't answer it with a comfortable yes, do further due diligence. It's also important to ask, if they're creating a new crypto asset, a token, a coin, a security, does it have the correct and compliant classification? And what I mean by that is every jurisdiction classifies crypto assets differently. So Malta has a 4-category classification. Japan has a single one. But if you're not familiar with it, again, putting money into a project where you're not 100% sure that the structure has been defined is very high risk and can be eliminated by a simple legal due diligence. Security versus non-securitized crypto assets. This is a conversation that keeps happening, ongoing. Now the flavor of the month is STOs and security tokens, but basically there are pros and cons into investing in both security and non-security ones. Obviously, the security ones, if you invest in a security token, it's like buying equity or debt in the company. So the legal framework is already there, but you still need to make sure they're compliant wherever they're launching the project in. The non-security tokens are mostly unregulated, and they could have higher legal exposure in long term because there's no framework within which you can define them. But they're easier to invest in because it's most often defined as purchase of software. So it's not a securities transaction. Another very important legal thing is the banking relationships. Does the company have a banking relationship? For most startups, that's not a big deal, but because we're talking about blockchain projects, you do want to make sure that they have a bank account, or they can have a bank account. The last thing you want to do is invest money in someone's personal account or buy tokens, and then they can't get banking relationships, which means they can't have revenue, which means there are a slew of complications that you need to deal with as an investor. And it also goes back to compliance. Few questions to ask. Do they have the right banking relationships? Where will the funds go? Under what entity? I mean, you will see very complex corporate structures for blockchain projects where there's a foundation and there's an operating company and there's a feeder company. It's almost like a very complex hedge fund. And if you have any doubts or if you're confused about anything, don't invest. Just do more due diligence or ask questions, or even if you're the lead investor, ask them to change the structure. If the raise is in crypto, when and how it will be exchanged? Very important question to ask, because we dropped in value and now they don't have enough runway to execute on all the projects. So what I look for is who's doing the treasury management, when are the exchanges happening, when the funds are coming in, and who has custody. Custody of crypto assets. So who has custody? The most important question that you can ask, because if something happens to one of the founders, I don't know if you guys follow crypto news, but just recently it was in the news that a Canadian exchange lost $146 million because the owner died in India and he was the only one who had access to their wallets, which is highly suspect, but let's believe that story. You don't want to be in that situation where a key person is the only person who can access the funds of the company. We look for multi-sig wallets. Multi-sig stands for multiple signatures. So similar to a bank account where you'll have the CEO, the CFO, the controller, and maybe one more person have access to it. So if something, God forbid, happens to the CEO, the CFO can still pay the bills, pay the payroll, continue the operation until someone else comes in place. Exactly the same mentality here. Do not invest in a project where a single person controls the wallet, there's no backup, and they have no treasury management. And we recommend outside treasury management so that if there's an internal conflict, again, the best example is Tezos. Tezos is a big project that raised over $200 million, and they couldn't do a single thing for 18 months because the foundation that raised the funds, the manager of the foundation in Switzerland got into an argument with the founders and cut them off. So they didn't have access to any of the money they raised. And that really hurt the project because they spent half of 2017 and 2018 just in a legal battle instead of building technology. So multi-sig is good. Odd number of signatures is good, 5, 7, 9, however, and third-party oversight, either as a custodian or any kind of board review is highly recommended. Now we're going to talk a little bit about what the growth strategy should look like. So I'm going to have Jason come up.
Thanks for that intro there, Brad. So I introduced you to myself as a marketer. I could have come up here and said, I'm an investor, as I am. I'm regularly participating in projects, in blockchain projects particularly. I could have come up here and told you I'm an entrepreneur, as that's another component to me. The reason I focus so much on marketing is because this is where I see projects succeed or fail. Brad has made excellent framework here about what to look for in terms of the business model, the team, overall infrastructure. Ioana has got in-depth about technology and even given us an education on how we can play the tech expert and ask the right questions in evaluating blockchain opportunities. What I'm going to do now in these next 2 sections is dive deep into what I scrutinize as a marketer when I'm putting my investor glasses on. And believe me, when I'm talking marketing with any project, they're pitching me as an investor as well too. Hey, do you want to participate in this? So I will go through a series of questions that I ask. And just moving on to the wrong slides here. Hold on. Just sliding down here a bit. Okay, we're getting close. May have to freestyle this here. Hold on I'm going to give this one more try. Now that the business, product, and overall structure have passed your tests, it is time to evaluate how this business will grow. Looked like it hopped around a bit again there. So, overall growth strategy. I want to know what marketing channels this business is planning on to acquire new users. Now, if this is in the fundraising stage, you're putting in seed capital, they're about to do a private investment round, this could be around investor acquisition, or maybe this is directly into their launch, post-public sale. Again, what are the key marketing channels? I break marketing down into organic and paid channels. Organic, we're talking social media, email, other types of community channels. This would include PR and influencers, social proof overall. This can be used to build a marketing funnel, but it can lack scalable metrics such as advertising. I'm an advertising fan because I know if a brand's going to be purchasing media, there's concrete digital metrics that can be used to determine how many people are going to see the marketing, how many people are in turn going to visit a token sale page or some type of offering page from those spends, and can even look at attributes of performance and average cost per acquisition for that, which leads to the next thing, the performance benchmark goals. So whether it's paid, whether it's content marketing, I ask founders directly, what type of numbers are you looking for here? How much are you planning on spending to acquire users? How much are you planning on spending to acquire traffic? If I don't hear at least ranges or some type of speculation, to me that's a red flag. That means this model is not thought out, and therefore if something doesn't work right out of the gate, they're going to be scrapping around to figure out some type of solution. So if I'm asking performance benchmarks, they have numbers in place. I can then look to see what are the industry averages. Thank you. I can then see what are the industry averages and if those are realistic. Again, I'm looking for red flags. So if there's just a very light plan that says we're going to pay some influencers and buy some sponsored content, there's no numbers associated, they have no idea about industry averages, there's not a sophisticated model, and there has not been enough thought put place. If it's then filled out with optimization plans to say, hey, this is what we're doing organic, this is what we're doing with advertising, we're looking to hit these benchmarks, if that doesn't work, here's what we're trying next. That, to me, is a sign of success. That, to me, is a sign of a group that is committed to hitting these results. They're not looking at marketing simply as a line item of their budget. They're looking at it as a vehicle to not only hit their milestones, but to grow. How is pacing of each user, investor, consumer set and increase? If you're playing a more active role as an angel investor and not only putting funds in, but looking to open the door to different relationships, and you have an idea of how this business can scale, this is the type of question you want to be asking. These are the type of answers that you'll be able to take on to your strategic conversations thereafter. So I know I'm getting a bit in-depth about this. There's a slide here about definitions, performance benchmarks, talking about the cost per user, cost per investor, which with digital analytics can be carved out and clearly defined. Content marketing, I know I touched on it a little bit, but social media, emails, blogs, videos, infographics, webinars, any type of digital content and the distribution of it. So those are questions to be asked. When I then look at best practices, and this is kind of emphasizing the points I went over in the questions there, understand the marketing plan the business will be using to drive each target audience. Evaluate the partnerships that support with social proof. I was just mentioning in the fintech panel next door that much of the internet is not trusted. Arguably, creating social proof is the strongest form of marketing that can be done on a token sale page, on a media kit, on any type of digital asset. The use of media publisher logos goes an incredibly strong way. Being able to show vertical groups, organizations, influencers, other endorsements that validate that this technology is real, this offering is real. This is something you can trust. Again, it can't be measured, the distance that this will go as part of a campaign, and how valuable it is today. When I started talking with blockchain groups and working with them directly in 2017, it was assumed that if they put together a good white paper, had a good team, had the right infrastructure for an ICO, they were going to be able to hit whatever numbers they wanted. And in some cases, they did. 2018, particularly the second half of 2018, simply not the case. And I really look at good fundamental marketing on success rates of private sale, of public sale investments. And again, there's a lack of trust, not only online, but in the vertical right now. So if there is an excess of social proof being showcased, a very good indicator to be looking at. Requesting any existing or past project reports on marketing analytics that the team has accomplished to that founding team. Again, when I ask this, I'm looking to watch their responses. If they're able to provide some type of documentation, particularly if it's first party, if it's something that they worked on, and use that as backing, as evidence on why these results are going to be possible. Moving on to number 4, document the timelines, milestones, and channels to produce growth and monitor closely. No one likes calling a group they've invested in and hearing the same response over and over again. If you're able to come to that conversation with numbers, with algorithms, and not just milestones that are continuing to push back, but hey, these marketing channels, they're live. How come we're not seeing this traffic? What's being done to optimize? How are we going to get to the conversions? What are the cost per conversion right now, and how are we going to get those numbers lower is going to be a much more productive conversation for you than the simple cookie cutter questions and hearing the scripted responses they're providing to everyone. Lastly, for best practices, look for clearly mapped systems to develop, nurture, and grow an audience, which moves us into our next section about the value of community. Actually, want to pause, though. No, I threw a lot of information at you there. Any questions? Comments, stories to share, anything like that at this point? Okay, perfect. Feel free to raise your hand. You know, can make this as interactive as you'd like if anything comes up. This next section is about the value of community. First slide, social audience valuation. Email, Telegram, and various social media audiences can be measured as an indicator of how much money a brand can raise. First was introduced to these projections in the world of reward-based crowdfunding, where pre-launch is crucial and the size of an audience could actually be put into a calculator and show how much money a brand could raise. Very true in blockchain investments here as well, and I've seen all different types of mechanisms to actually calculate the worth of these social audiences. Moving on to the next slide here, I'm going to be able to get into that further, but not only looking at the size, as we all know, that can be manipulated in different fashions. People can buy users. People can have a strong marketing campaign to bring on a high amount of social users, and then they just drop off, just a lack of interest. So looking at the size, looking at the engagement, looking at the frequency of communications among a project's community provide a very clear view of the brand's value. Some of the most successful projects I've been a part of didn't necessarily have the largest Telegram audiences, but very active Telegram audiences, very engaged Telegram audiences. And if you're looking at the measurements of even as Telegram and their 200 plus million users, the amount of engagement and comment that these users are getting, you can start putting numbers on these, finding comparables in real time for what users are worth. On the social side, look at different conversion rates of how many of them could participate in a public sale, look at how many of them could become users. Most importantly, daily active users is what a company will ultimately be living off of. And that's why these are not just vanity metrics. In many cases, not only is the community size tied directly to valuation, even being built from perceived average value of users or lifetime value of a customer, which to me becomes the most important metric. And if I'm looking at an overall growth model, analyzing at the LTV, the lifetime value of a customer, gives me an idea of how much I can pay to acquire a customer. Therefore, I can look at audience size, audience availability via marketing channels, and provide strong recommendations to scale. So looking at all of these pages, and as Brad mentioned, happy to send out this deck afterwards to anyone's email that we have on file. I really can't stress enough how important the role of marketing plays in blockchain investments, in blockchain technology today. Being able to dive in, make sure there's a thorough model, staying with it in real time and looking back at those numbers with the team, even being able to play a collaborative role and ask what, again, could be scaled to take the brand to the next milestones will add to a very healthy investor-company relationship. So that's why I wanted to go over all this today. Pleasure speaking with you all. And Brad's going to be coming up here to talk about summary of best practices in angel investing.
Thank you, Jason. We're getting close to the end. So again, I'm going to quickly simplify what Jason was saying. Have someone do due diligence on the marketing of the project. You may not be a marketer. You may not really understand the metrics or want to learn about the metrics, but even if it's a quick glance, an expert can say, this sounds like a realistic plan, or stay away from it. They don't know how to sell the product. They don't know how to grow, which is really important. So summary of best practices: invest in areas and industries you understand and have experience in. It's really simple. If you are a potential user of the product, or you understand it well enough to be familiar with it, that's a really good starting point for an investment, because then you don't need so many expert advice to decide and rate the project. If you're going to be a user, again, your investment may be justified just because of the use case. Like, I invest in things that I will use, because even if the return is zero, just the improvement in my life that that product and service is going to make is worth the investment. And conduct due diligence. We're going to leave you with this. Please conduct due diligence. Don't just write checks to people without doing your technical, legal, business, marketing due diligence with experts. A lot of the times, founders pitch the same idea hundreds of times before they get to you. So they get so good at it that it becomes a sales process. You hear them, they're passionate, they're giving you this spiel about how amazing this is going to be. If you don't take time to slow it down and do your due diligence, you're going to have surprises. And you know, when we're investing, we don't want surprises, we want results. So conduct due diligence. And this is just my personal mantra: don't invest in a project if it's too complicated to understand. If you have no clue how the project works, how the product works, how you're going to make money, how they're going to make money, don't even attempt it. There are exceptions. Again, it may be someone you previously invested with. It may be a serial entrepreneur. Maybe someone really well known. The project may be complicated, like biotech or pharma tech, that you don't understand, but you understand the results. This goes for someone brings you a document that's gibberish. You look at it and you're like, what is this? I mean, it should be pretty obvious that that's a pass, but I've seen people write really large checks to projects that they have no clue what it is, and they just want to be a part of it. And then, of course, when something goes wrong, they're utterly disappointed because it didn't work out. So we are Blockchain Investors Consortium and Beyond Enterprises. Here's our contact information. If you give any one of us your business card, we'll send you the deck with more notes. If you have any questions, just find us after this pitch, and we're happy to answer. Unless you have questions now. Guys, you want to come to the stage? Let's see if anyone has any questions for any one of us.
I have one general question.
Sure, go ahead.
I think you can hear me from this side.
We can hear you fine.
Okay. To whom it may concern, to whom it handle the question. I usually define market size as good problems to be solved. How big the problem? So what can be the best problems to solve with blockchain technology?
That's a very open-ended question. So I'll pass the mic, but my personal belief is blockchain, the lower hanging fruit, the problems to solve with blockchain are around trust, so you can do it trustless, around access, so you can give a lot of more people access to certain things, transparency, and you know, as far as industries, you can just pick it. There's so many problems we can solve: identity, access to capital, banking, tracking. I mean, there's a lot. But again, maybe my colleagues have different answers.
I think that the biggest and easiest problems that can be solved with blockchain are those that involve keeping data integrity for different things and minimizing corruption in private or public institutions. So whether we talk about digital signatures, identity storage, or any kind of good, that would be something. When you have a document in the cloud, you see the history of changes. So why wouldn't you do that? Wouldn't you do that for a law or for a document in a public institution? Also tax registries to see who has paid what kind of taxes, everything that involves ledgers, and anything that involves tampering with data and minimizing any kind of changes to it.
Any other questions? Anyone else? Going once, going
Sorry, I don't have much information, so I'm just asking this blindly. Is there any other enterprises or people who will help us with this due diligence if we're alone? We've never done this before. How do we tackle that?
Absolutely. So Blockchain Investors Consortium, as I said, we're an organization that does deal flow and due diligence sharing. So we prepare due diligence packages on projects that we believe in and share it with the consortium. But there are other entities. Obviously, your legal due diligence.
Microphone, please. Microphone.
The legal due diligence, that should be an attorney that you're comfortable with, as well as an attorney that knows the jurisdiction the project is in. Technical due diligence, again, we have a very strong technical team, but you can find a local technical team that you've worked with or that you're comfortable with for easier access and ask them to evaluate the project. Again, they don't have to be blockchain experts. They just need to understand, is the budget that's given for whatever they're building realistic? This is all about asking questions. It's not about doing the work for the entrepreneur or knowing everything yourself. It's just when you ask the right questions and you get a response that's a red flag, you can just not invest and save some money.
Just to add another note to that, whether you're contracting a third party to do the due diligence, marketing as an example of our due diligence, we have a system with 200 boxes that we check of things that we're looking at. But let's say you are doing the due diligence on your own, you're putting together notes on marketing, tech, legal, what have you. Consult with a professional to show them the due diligence and see if they could point out anything further. And it would be a different working relationship, but I would still recommend that level of sign-off from an expert who's, on the front lines of these projects day in, day out.
One of the dearest customers of mine, for every piece of software that we developed, had 2 companies that did the auditing. 2 independent companies which were in no way connected to ours. So when it comes also to technical due diligence, I would look at the auditor to be as independent from the team as possible, so as to avoid any kind of corruption, any kind of deals that are done between them. We have done technical due diligence and auditing for blockchain, and not only blockchain, but also mobile and web projects. Yes, we don't audit our own code. It would be like I would be the parliament and the executive power in the same state, or I would play in the 2 teams on a court. So it's important for the diligence to be done by another team than the one that writes the code, and to be as independent and unknown to the original team as possible, so as to avoid any kind of conflicts that may then come back as a backlash to you as an investor.